What's up, guys? My name is Nick, and welcome to the channel. In this video, I'm going to be showing you guys the top 7 stocks to buy in January. Now, I will mention before that I do own all of the stocks on this list, except for one. I own that stock a long time ago, and unfortunately, I sold it because after I sold it, ended up doubling. It is the one that got away. But let's get right into this. What we're looking at is the share price, 52-week range, the volume, market cap, the beta, the PE ratio, the EPS, and the dividend yield. We'll look at the price movement a little bit for just this year and the income statement and balance sheet. So let's get into the first stock, which is Intuit, ticker symbol INTU. And Intuit's a global technology firm. It creates financial software for consumers. What I'm really looking at is they have QuickBooks, TurboTax, which have used every year for the past 3 or 4 years, and some other ones. They own Mint and Credit Karma. And if we look down here, they've had a return in 2021 of 69.3%. That is an incredible return. And so let's go look at the data of this stock. As you can see, Intuit has a share price of 577.26. So yes, guys, that is really high. And let's actually look at the 52-week range right here, right down here. Has a low of 359 and a high of 716. So it still has room to grow. Still think it's a great stock, even though it's really expensive. As you can see here, they say it's overvalued. I do agree, but this is a company that is very solid in the finance space that just keeps growing. And so as you guys can see, it's actually dropped in price throughout the beginning of the year. So now might be a good time to buy in while it's rotated down. So next I want to look at, well, we have 163.46 billion for the market cap. We have a beta of 1.03, which means it's pretty good. It's not very volatile, maybe just slightly volatile, but otherwise really good. A very high PE ratio, but once again, that goes with the overvaluedness of the stock. But I still think this is I still think that if you're looking at the top stocks to own in this decade, Intuit would be on that list. Put maybe Domino's because they've always performed well. And I'd say Microsoft would be another pick for this decade that should soar. So this could actually be dirt cheap prices when compared to 2030. Next, you have an EPS of 7.58. So for every one share you own, you're getting $7.58 back. Dividend yield 0.47%, very low, but they do have high dividend growth in the double digits. Now let's go down here because it does show the revenue growth. So you can see in 2020, 7.68 billion, 9.63 billion in 2021. So they increased their revenue by $2 billion, which is incredible. Next, if we can get the financials up. And we already saw the revenue, so let's go to the balance sheet. You can see total assets 15.5 billion. This is what I'm also looking at, 2.48 billion in debt. And you can see they decreased their debt by quite a bit, 1.2 billion. So that is another good thing that I'm looking at. And let's move on to the next stock. So like I said, this is a stock to buy for the long term, 10, 20, 30 years. I think Intuit's got it all. So let's go right back into this. The next stock, probably my favorite stock, Microsoft. It says once again, they're a technology company. What I'm really looking at when it comes to Microsoft is their Microsoft Suite, Office, Word, PowerPoint, Outlook, now Microsoft Teams, since a lot of people work at home. Their cloud computing which is another great feature that Microsoft is in. And of course, you have gaming with Xbox, whatever Xbox is out now. I don't know. I used to have Xbox 360, but I know they have the subscription with Xbox Live. They've also got their hardware. And as you can see, Microsoft had a return of 51.21%, which that was crazy in my portfolio, how much this went up. Let's go back to Yahoo and type in Microsoft and do some research on it. So as we can see, price range of 318. It's also gone down over the year since the beginning of the year. So this might be a great time to buy in. If we look at the 52-week range right here, a low of 212 and a high of 349. So it still has room to grow. Once again, they say it's overvalued, but Microsoft, like Intuit, it's one of those stocks that's going to dominate the decade. They're really catching on to Amazon and cloud computing with their Azure. And I think that is one of the biggest business sections that you should look into when it comes to Microsoft. Now, earnings per share, 8.94, PE ratio of 35.6. So not as crazy as Intuit's. They have a 0.86 beta, which is less than 1, which means they're not volatile at all, or very low volatility. 0.79% dividend, and they do increase it by either, I think last year it was 9.8%. So it's very close. That's a very solid dividend increase, and it's very close to double digits. So now let's go to their financials. And of course, 143 billion to 168 billion in the past year. So that's a 25 billion increase, which is incredible. See if we can look at the balance sheet. Total assets, 33.7 billion. Total debt, 67.7 billion. And as you can see, again, they dropped their debt. They dropped their debt here by about 3 billion, which is something that I like to see. So again, I own Microsoft stock. I'm going to keep buying more of it. So let's move on to the third stock. We've got Costco, which I know I said Microsoft was my favorite stock. Maybe Costco and Microsoft are head to head on my favorite stocks, because Costco is another great one. Everybody always says they want to buy that Costco's overvalued. They want to buy it when it comes down, but it just never seems to dip, never seems to drop. But we already know what Costco does. They own the warehouse wholesale store where you buy a membership, you go in, you can buy huge bulk products. Like, I know I love the 5-pound peanut butter. I have 3 things of ketchup that are this big. Bought a whole bunch of toilet paper, paper towels, tissue, and they had a return last year, 50.67%. Another great year from Costco and from one of my stocks. So let's go look at their information. Cost, as we can see, 525.8, 52-week range of 307 to 571. As you can see, they have dropped down this year. So now, I know a couple days ago they were down like 9%. So now might be that time to get a 9% discount on an amazing company. And we see a market cap of 233, beta 0.64, very low volatility. They do have a high PE ratio, but that earnings per share of 11.63 is incredible. They do have a very low dividend yield, 0.61%, but they do always give great dividend increases. And usually every other year, they give a special dividend in December. Now, they didn't do it in 21, they did it in 20. So we could see a special dividend in 2022. So now let's look at their financials. This always takes forever to load. So as you can see, wow, they almost increased their revenue by 30 billion from 2020 to 2021. That is incredible. Another thing that I'm looking at with Costco is, I guess I won't show the balance sheet right now. One thing I'm looking at with Costco is that they're starting to get more into online sales, which is really something that's going to boost up their revenue. So as you can see, total assets 59 billion, total debt 10.133 billion. It went down just slightly, but I'm not worried about Costco paying off their debt. They're a solid company with a great track record. And with that being said, let's get into the next one. Now, the fourth stock is Pfizer. So as we know, they have medicines, vaccines, most notably for the recent virus. And Pfizer is just going to continue working on, as it says, wellness, prevention, treatments, cures, and those boosters. So we have a 2021 return of 60.42%. Oops, you guys saw the next stock. But 60%, I'm surprised it actually beat Microsoft, but maybe that's just the times we're in. So hopefully you guys forgot the other stock while we're focusing on Pfizer. It's got 56.65. They're saying it's near fair value, the experts. We got a 52-week range of 33.36 to 61.71. As you can see in the year to date, it's gone down a little bit. It's starting to come up. So now might be the time to buy in, get in there before it starts running up again. And let's see, market cap of 317 billion, a low beta of 0.64. It's not very volatile. That's great to see. And this one actually has a low PE ratio, which is also great to see. EPS of 3.5, dividend yield. So Pfizer, it's nice to have a higher dividend yield of 2.82%, but I don't think that they increase it as high, especially not as high as the tech companies, but they do give a decent increase. And wow, we're actually looking at revenue dropping from, oh, that's from 2019 to 2020, but I'm not sure. It's not showing the 2020 numbers. So maybe if that 69 billion is their revenue and it's increased, then that would be a good. So now let's go into their balance sheet. They have total assets of 154 billion and total debt of 38 billion. So we are, even though this is 2020 numbers, we are seeing them lower their debt by 14 billion, which is really good, really awesome to see them lower debt. It's awesome to see any company lower their debt. And so let's get into the next one, which you guys saw. It is Stag, S-T-A-G. So they're a real estate investment trust. They focus on single tenant, like large warehouse distribution centers. One of their biggest clients is Amazon, and Amazon has been just building a ton of warehouses throughout 2021 and 2020. They're going to build a lot more throughout 2022. And they had an amazing return of 59.07%. And I am glad that I picked up Stag right at the end of the March 2020 crash. So we're looking at 44.41 for the stock price. It has gone down during the year, since the start of the year. We've got a 52-week range of 29, and I wish I could go back and buy more of this stock at 29. And so that Yahoo's actually saying that it's undervalued. Wow. I think I need to go back and buy some more of this. Start just throwing money at Stag. They've got a market cap of 7.77, all lucky numbers, and under 1 beta, which is good. 35.93 PE. That's pretty good. Seems a little high, but I'll take it. An EPS of 1.24 and a dividend yield of 3.28%. And they have very low dividend growth. But I own Stag for the monthly dividend. They pay it at the middle of the month, every single month. And I just use that to reinvest into my other stocks. Now we're looking at REITs, the financials, they're going to be different because they do have to pay out 90% of their earnings into dividends. So yeah, we don't have the 2021 numbers, but you can see they increased their revenue from 19 to 20 and from 18 to 19, which is good. Now we're going to look at the balance sheet. Sometimes it's difficult to get that. See if it pops up. So their total assets, they increased them from 19 to 20 and a lot from 18 to 19. Total debt, they've increased their debt, but it's a REIT. So I'd imagine the increase in debt, they're buying more properties, more tenants, which are giving them more revenue. And one thing I do want to point out, the great thing about Stag and their tenants is they're on triple net leases, which means the tenant is paying for, let's see if I can remember this. They're paying for property taxes, maintenance, and insurance. So Stag does not have to worry about any of that. And those are all huge expenses. So it's a great way to keep down their costs. So let's get into the sixth stock, which another great one, Home Depot. Guys, we all know what Home Depot does. They sell all kinds of stuff from lumber to cleaning supplies to, lights, plumbing. They have it all for anybody who wants to build or work on projects at home. They also had an amazing return of 56.24%. That is incredible. So let's go check out Home Depot. So they have a stock price of 389.4. They're also dropping since the beginning of the year. So we have a 52-week range of 246 to 420. Yahoo is saying that it's near fair value, so it might be the time to grab it. They have a market cap of 406.62, a beta just under 1, a solid PE ratio at 26, 14.95 earnings per share. That is great. I think that's the highest we've seen so far. And a dividend yield of 1.71%. I would have thought they were under 1%, but that's better for me. And Home Depot is known for having great dividend growth too. So let's look at their financials. 19 to 10, they saw a little bit, 2 billion in revenue growth, but from 2020 to 2021, we saw 22 billion growth in revenue, and that is great. Oh man, come on, let's see the balance sheet. So they have 70 billion in assets, grew by 19 billion from 2020 to 2021. And total debt increased. So it increased a lot from 19 to 2021, 2020, and increased a little bit from 2020 to 2021. Still, I would say Home Depot is a solid company to buy. I think they're going to be incredible in this decade coming up. And let's get on to the last stock, which is ADP. They are for HR, payroll, taxes. Whenever I look at my pay stub, it's always done from ADP. It's very well organized from like everything from gross to net pay to benefits to how much I put into my 401k. And they had a return of 39.94%. It's another great return for 2021. So let's look at their information. So we have a 234.63 price. It's gone, this stock has gone down throughout the year since the beginning of the year. The 52-week range is 159 to 248. They are saying it's overvalued with a market cap of 98.86 billion, a beta under 1, kind of high PE ratio at 37.12, good EPS at 6.32, a dividend yield of 1.77%. And while I don't remember ADP really increasing their dividend yield that much, I still put them on this list as a buy because as more people get jobs, as we increase our population, that's just more businesses using ADP, using their services, and they are a solid company that provides an amazing service. As you can see, the revenue increased a little bit. I'm sure a lot of people not being able to work has hurt their revenue growth. And once everything hopefully gets back to normal over the years, ADP will see more growth. And let's see if we can get that balance sheet up. So total assets actually increased by 11 billion, or I'm sorry, 9 billion over the past year. And their total debt also increased. But guys, with that being said, those were the top 7 stocks. So thank you for watching my video, guys. And, do your own research. But I'd recommend looking into those stocks. Don't forget to like the video, comment down below, let me know what you think, and subscribe. So thank you guys for watching, and I'll see you next time.